Pull out your phones because this is an actual info deck that you're going to about what you're going to be learning. Follow along, or if you want to reference back to something. So I want you to be able to follow along. But as I promised, Eric, your book, here it is. Everybody scan this. It's a PDF file. Go ahead and read it on your own time, your own leisure. Scan that QR code. And then lastly, many of you know Carlos Lee. This is the gentleman, him and his team of 4. They're head of the compliance that will literally cipher through all of the investment docs before we give you a call to verify the money is going out. Quinn, it is all yours. Thank you.
Thank you, man. Hey, can you see my slide okay?
Yes, I can. Please.
Awesome. Let's jump into it.
Go ahead, bud.
So again, just very excited to share this because it has been it made such a financial impact on my life. I know it has with Eric's. We'll get into that. Today, we're going to walk through basically our struggles with other investment models. We're also going to talk about, how we were personally led into notes and why that's important. The strategy itself, of course. We're going to talk about why land. I know that's a main question a lot of people have is what in the world. This is a little bit different. It's a little bit unique, and we love that. We love the niche that we're in, and so we'll talk about why we use land as our collateral of choice, and then of course what the fund does. What's the strategy, and we've got 2 main, very simple, clear strategies that we employ within the fund, and then lastly our performance. Where are we to date, and where are we going to go with the fund? And I think we got some time for Q&A at the end.
Absolutely.
So we don't need to belabor this. I know we did our introductions, but I think it's also important to note really what led me into land was really my struggles with other investment opportunities. Number one, the volatility and the unpredictability of traditional investing. I knew that I was just me personally. I knew that I was a real estate guy. Like I knew I wanted the tangibility and of real estate. I knew I wanted to be able to reach out to deal sponsors and fund managers directly. It just made a lot of sense to me. I knew I wanted something backed by real assets without ever losing, with very low risk of losing principal. That was of utmost of importance. I had to have something that I understood. Like it had to be like just very intuitive to me, something that I could just back of the napkin do the finances for. And if that made sense, like I did not want any elaborate spreadsheets to make sense of an investment opportunity. If it got too complicated, I was throwing it out. So I wanted simplicity. But I I got into real estate, and I know Eric's going to talk about his experience with direct ownership of, being a landlord. So he can talk about that. I didn't do much of that. What I tried was syndications. So I jumped into, jumping into both funds and individual deals. But the main problems for me were I never knew when I was going to get my distributions. I mean, it was just so unpredictable. And that was just my experience. Not to mention the fees a lot of times were eroding the returns. And so you'd see the good looking returns on the performas and the estimations but all to find out that the fees were eroding that. And so really generally it was just a lack of transparency and a lack of alignment that kind of rubbed me wrong on a lot of those syndication deals I was doing. And I mentioned how and why I jumped into note investing itself. It was an Army mentor of mine who was retired. He was spending a ton of time like with he called them leisure goals. He was fishing and golfing and spending time with his grandkids. And I knew how much generally he was making with his pension. And I'm like, well, sir, how are you doing this? What are you doing? Like, and that was he introduced me to land and what he was doing. And so I co-invested with him just passively into notes and lending, and all backed by vacant land. And it was very rewarding. I was able to kind of snowball those investments, reinvest all profits back into my portfolio to the point where I now support my family on this exact strategy that we're going to talk about. While I was doing that, while I was building that portfolio, I was working as a commercial real estate developer. And so I kind of got to see both sides of it. I got to see the deal sponsor side and putting together these large, complex deals. And quite honestly, all the all the assumptions and the risks involved with some of those larger, sexier deals. And so that's one of the reasons also why land was so attractive, because I'm like, look, it's simple, it's scalable. You can understand it on the back of the napkin. And I see my mentor over here, and it's literally changed his life. It's created a very simple and passive and safe, secure, predictable passive income for him. And I'm like, man, how do I do that? Because again, my priority was time. It was time for family and time for my hobbies and everything else I wanted to do. And so when I jumped into land, it really it changed my life. And I don't say that lightly. And so that's for those reasons I'm excited for this and for the opportunity to kind of share that. I was investing with friends and family, but now with this fund that we're coming up on a year of having it underway, it's going great. It's exciting to kind of open the door to other accredited investors for them to kind of experience the same financial freedom that we have. Enough about me. I know we want to get into the fund, but first I want Eric to kind of tell his quick story about why land made such an impact for him.
Yeah, so what I love about the land investment space, I've done several things in real estate investment, is its simplicity. So what we're doing in the fund is not buying huge apartment buildings and repositioning them and driving up rents and taking on huge amounts of debt. We're not litigating with borrowers. This is only acting as a bank, and we are simply collecting monthly payments. And we follow two strategies to do that. The first one is that we work with land sellers to help them sell their land with seller financing. We guide them through the whole process. We help them pick a borrower that we want to deal with over the long term. We handle the whole process for them, and then we purchase that loan from them at discount at closing, and that allows us to control our yield. The other strategy that we follow is that we originate safe, short-term, very, very low LTV loans to land investors who we know, and we charge an interest rate based on the fact that they are going to be flipping these properties within a year. So that's it. Essentially, we're just operating as a bank, collecting a predetermined yield and sharing those profits with investors.
And I think that I appreciate that, Eric. The simplicity of the structure from the outset of this fund, we wanted to carry over the simplicity of the investment model into the simplicity of the structure of the fund itself, from a legal standpoint and from a distribution standpoint. So the slide you're seeing now is really twofold. One, it's the offering, and two, it's a sample investment of $100,000. So the two most important, I guess, features of the fund. Number one, it's a 10% preferred return. So it's the first 10% that the fund earns goes directly to our investors. And the second thing is that Eric and I are very proud of is that we offer monthly distributions. So as opposed to the kind of the syndication model that I was talking about, that I was turned away from when I didn't really know when I was going to get those distributions, whether it's 6 months or 16 months, we offer them immediately. And we're able to do that because of our tremendous deal flow that comes through the fund. And so that's exciting to be able to offer that. Those are really the main two things. There's no upside to the fund. It's just the 10% pref, and it's the monthly distribution starting immediately. And so you can see with a $100,000 investment, you really investors have two options. They can choose to take distributions monthly. So at $100,000, you're earning an extra $833 a month, and that goes directly from our online investment portal through InvestNext directly into your account. Or you can choose to compound. You can choose to reinvest all those would-be distributions back into the fund and compound your return, which, by the way, most of our investors are doing. Because as you can see on the slide, it increases your returns. Over 3 years, that 10% soon becomes 11.5%. And then over a short 5 years, you're up to 13%. And of course, the strategy of the fund with its simplicity and safety lends itself well to that second compounding option, because most people are not jumping into this fund for an extra income. Some are, but some are looking for a safe place to preserve capital. Number one, and number two, they like it to grow. I mean, but it's not going to 3x and 4x. It's not what we're offering. We're offering stable cash flow. It has nothing to do with tremendous growth. We just don't have that risk return profile. And so I know we will get into more questions on this later, but that's generally our offering and our sample investment. It's a simple model and it's a simple offering.
Quinn, speaking of the questions in my private chat, they are already coming through.
Let's
And
go.
I know that you IRA Club clients, again, there's only so much that I could say. I always say at the end of the day, please reach out to Quinn and Eric. Again, I know that part of your presentation will be a call to action. So one person asks, so the initial investment is 100,000, just so the minimum, is that what you're saying?
The minimum's I'm sorry. I probably should have put that. The minimum investment's $50,000. I used 100 just for easy math.
For easy math. Okay, thank you for saying that, because I got two people just literally fired away in the chat. Next question is, so the overall minimum time period is 3 years?
No, the lockup is only 1 year. And we're
Okay.
able to do that because we split the investments between longer term loans and short term loans. So at least half of our portfolio is a loan duration of 12 months, which means that we are constantly receiving payoffs. And that's why we're able to only require a 1 year lockup, which is rare for a debt fund.
Which is rare for a debt fund. So, and maybe we're getting ahead of ourselves. Chris asks, this is great. Where is the risk? Question mark.
Yeah, we're
getting ahead of
actually,
ourselves.
I'll talk about the risk at the end.
Okay, awesome.
Because we're going to actually discuss the fund metrics, the current Q3 metrics, so you can see where the risk lies.
Yeah, maybe is that our next slide here? Why don't you, Eric, talk about why land and then get into our fund performance. And then that'll answer a lot of these questions that I think are coming through as it relates to the risk profile.
Yeah,
Awesome.
absolutely. So people ask frequently, why are you investing in land? And there has really been, since COVID, a transition in where people want to live. And this is really allowed by some huge technological advances. The first one is that, delivery services are really making remote living possible. You've got Starlink, you've got solar power and batteries. You've got work transitioning from in-person 5 days a week to more of a split between remote and in-person. So people really want space and they want flexibility. So what we're seeing is, in the current housing crunch, we're seeing people really wanting, instead of living on a quarter acre in a crowded suburb, wouldn't it be nicer to be able to live on 7 acres, outside of within an hour of a metropolitan city? The other thing that we see frequently, excuse me, is that with mobile home lots, people increasingly don't want to live in mobile home parks. They would much rather live on their own 5 acres on a mobile home, if it's zoned for that, than they would paying lot rent. So we're really seeing a lot of transitions due to the housing shortage. We're seeing a lot of transitions in really the demand. The other issue is where we're seeing the demand. I'm going to show you a map of our current investments in a minute, and people are moving to the Southeast. And so because of that, we're seeing people really building their own homes on larger acreages right now. So this is the current fund performance. This is going to be as of Q3 when we release that in about 2 weeks. So you can see our average investment yield is right around 19%. So we're taking in 19%. We're paying 10% to investors. We don't have any current delinquent loans. We have 34 active loans, which are split between long-term notes and short-term loans. Now, the next data point is extremely important, and it has to do with the risk. This is our average investment to value. Now, investment to value is what we pay for a loan or what we lend versus what the property is worth. And this is really an absurdly low metric. Like, for example, most banks lend at 75 to 80% loan to value. Ours is at 35%. That's important because if we get a default and we have to go through the foreclosure process, the question that we're asking ourselves is, are we confident that we're going to be able to sell this property for what we've invested in it? And at 35%, I'm confident that we would be able to do that. The other important metric is that our average down payment for both notes and loans is over $25,000. And in my experience as a note investor, people do not put down $25,000 in a down payment and then walk away. Our average down payment percentage is 25%. Average property value is about $150,000, and average acreage is 14 acres. So the next you can see where the investments are, and really they're overwhelmingly in the Southeast, where land is in demand, where people are moving, where people want to live. In the lower left-hand corner, monthly income versus liabilities. This is a huge metric. Our liabilities for the fund, we currently have raised 1.5 million since January. Our liabilities are 12,500 a month, and our income is about 30,000 a month. So the natural question now is like, what are you guys doing with that extra money? That's over $15,000 a month that you're taking in the fund. Are you taking that out of the fund? Are you paying yourselves that money? The answer to that is no. That extra money is used to originate new loans and purchase more notes. This creates a snowball effect where over time, that difference between what we owe investors and what we pay investors and what the fund is bringing in is that much greater over time, which means that there could be a catastrophic default and the fund would still be able to pay the investors. So in the next metric to the right, you'll see our UPB versus funds under management. We've raised right about 1.5 million. We are owed 1.92 million. And that is because a lot of our investments are loans that we have originated for 100% of the loan amount. The rest of the loans we have purchased at discount, typically about 75%. We pay about 75% of the balance of the loan. So then the loans versus notes breakdown. We're at about 730,000 in notes, 1.19 million in loans.
Awesome. Before we jump into the next slide, and Quinn, always feel free to jump in the Q&A, and you could feel free to answer them while Eric is talking. Bob asks a question. Is that loan to appraised value or some other notional metrics of valuation?
So we didn't talk about the due diligence process that we follow, but we do exhaustive due diligence on the land because land is a lot different than residential properties. So we have a pretty sophisticated due diligence process. In terms of valuing the property, we do require at least one local realtor opinion from an agent who has visited the property. And then I have two of my own independent appraisers who are land investors who look at a lot of different metrics. And then I compare their independent analyses of the properties when I determine the value.
Hope that answers your question, Bob. Oh, there you go. Thumbs up. All right.
Yeah,
that's all I have.
Yeah, the one thing that I'll add on this slide, and I want to make sure that the individual that asked about risk, we answered his question fully. He asked about, what are the risks? What are the downsides? And Eric mentioned the down payment, the strong down payment. Not many people are going to walk away from $25,000. 25% of our average, our average deal, which people start walking away from it. We also do credit, a variety of other things like credit checks and personal guarantees. I think another big thing that so that's how you mitigate risk per deal. But in general, the fund has a low risk profile because of the average property size. Eric mentioned the $150,000 property value. These are smaller deals. I mean, we're operating with volume. These aren't, as opposed to, again, I know I keep going back to like the syndication model, where a fund, a syndication might be a single asset of, tens of millions of dollars. All your eggs are in one basket. Or if it's a fund, if you're smart enough to jump into a fund where it's diversified, there might be a handful of properties, 2, 3, 4, 5 larger properties. Great. If one goes down, that's 20 or 25% of the value of the fund. We're going to have hundreds and hundreds of deals because our deal size are so small, diversified across tons of states. We take pride in that, and we get presented with other larger deals all the time, and we choose to dismiss those because that would go against the risk profile that we're trying to stay under. So I know I'd love to get to the Q&As because I think there's some good questions.
Quinn, I love that you said that. And I try to explain that to people in past webinars or podcasts. Basically, the risk isn't put inside, as Eric said, one basket, right? Just like I say sometimes to you, like, do you think all of your retirement accounts should sit inside the stock market? My answer is always just going to, my opinion is always going to be no. I believe in diversification at the end of the day. I believe in hard assets at the end of the day. So again, it's a fund, it's a pool, right? Quinn, you said it best. It's a pool, right? It's not just one individual parcel of land. It's multiple parcels of land. That's where it kind of eases off the risk factor. So I just want to bring that to light.
So I'm sorry.
Go ahead, man.
Well, I was just going to say that, Quinn and I believe so much in the fund that we each made large contributions of our own capital into the fund to get it started. That's how much we believe in this model.
Well, it's just, I always say to people, if the fund manager does not have skin in the game, walk away. I always say that because they have as much to lose as you do.
Yeah. And if we're invested directly in the fund, but I think even beyond that, like this, again, I know it goes for Eric too. This is the exact strategy that we do in our personal lives. Like it's how I was able to leave my W-2 job, these exact model. And so like, regardless of like I don't know. I think I'm there. I have a lot of conviction about it because I do it personally. It's not like I'm doing this thing over here and then, hey, let's create a fund and pitch it to, it's what we're doing personally, privately. It's what we've been doing for years. Now let's just introduce the market to it. Is kind of the thing.
I got a pop-up question for you. Charles asks, how are your loans performing over typical default rates in each state you are participating in?
So we currently do not have any defaulted loans.
Okay.
I've originated, so I originate loans outside of the fund with my own capital. And I've done in the last about 14 months, I've done about 160 loans, and I've had one default. Over 160 loans.
Got it. I got a direct one from a client, just the initials DB. Says, you mentioned that people are wanting to move outside major cities. Are the average people using this option individuals or farmers? Are they individuals or farmers?
Yeah, no, we don't get involved in any farmland. These are all residential in use. We don't do any industrial or commercial. These are typically going to be recreational sites, hunting sites, vacation home sites, primary home sites. Most of these are going to be built at some point. Although we don't provide any financing for the construction, these are just acquisition loans. A lot of people will purchase this land and they'll hold it with the expectation that they're going to build it, later on in like in retirement.
I'm just asking any reason why farmland's not in the as part of the
Yeah,
profile.
so farmland is very expensive and it tends to be sold in very large quantities that are financed by banks.
Okay.
We're essentially in a category underneath where banks lend.
That's right. Yeah,
Got it.
I think we breezed over it in the Y land slide. Maybe I'll just pop back there if that's okay. Maybe I can. Let's see. I forget it. But the banks, they don't want to play in this space. They're too small. They don't know how to underwrite it. They don't want to be in what we're, so we basically serve as the bank for some of these landowners and borrowers. And so zoning to the question, zoning is an important part of our due diligence. So if it's like heavy industrial or farmland or something, like, it's a hard no. We want residential land. We can underwrite that very easily. We want to keep things simple. If it has a structure on it, it's out. If it's zoned X, Y, and Z, it's out. Like, what's the future use of this land? And we want it to go to people, to Eric said, anywhere from, 0.5 acres to 50 acres to 200 acres. Like our average is on here. Our average acre size is kind of the mid-teens, but it's residential use. And we don't want it too large, or else we're playing in the sandbox of the large banks, and that's just not gonna help us.
Got it. Emily asks, I joined too late. No worries, Em. Better late than never. That's what I say. What is the average interest rate charges, and what is the value of the fund today?
Yeah, so interest rate, I think, is better expressed in yield, which is our annualized return on investment. So when we purchase a loan at discount, we are able to control the yield. And those loans that we hold are typically yielding about 22%. The loans that we originate, the coupon rate is 18%, but then we have some fees included as well. So right now, our average yield, which is what we're receiving on the capital invested, is 19.3%.
19.
In terms of the value of the fund,
Wow.
we are owed at this point $1.92 million.
Just to clarify on the interest rate, I mean, that's the rate that the fund receives. We charge borrowers upwards of 10% interest rate. So we simply pass that interest rate basically on to our investor with our 10% prep. And we're able to achieve the yield that you see on here because we're buying it at a discount, a discount to the face value of the note. So the fund, that's how the fund makes a profit. But the 10% from borrowers goes, that goes directly to investors.
Thank you. Now, do you want me to continue? Is there anything more that we want to illustrate?
No, I was just going to show just kind of the two ways that, again, it's a simple model. It's a simple structure, and we're simple people. So there's two ways to get a hold of us. You can go to our website or email us. I love to talk about our fund. If you haven't seen that already. And so I'd love to jump on the call with anybody that has further questions. I know there's a lot of them. So it's our email address or our website, where you can also download the book.
Understood. Okay. And somebody in the chat asks how much is the interest rate you are currently offering to clients, and who wants to buy land? Forgive me.
Pardon?
I think you already answered that. So
no.
I saw another question pop up about compensation.
Please.
So how is the fund and the fund managers compensated? So we do not view this, and this is unlike a lot of funds, we do not view this as a salary. Our goal in this fund is the long term. So we are paid a 2% management fee, but we haven't taken that fee out yet. Our goal is the snowball effect. Over time, there's going to be a considerable difference between the income in the fund and what is owed investors. And the feedback that we have received is that investors prefer security over the long term to a huge return. So they would rather have a 10% that's secured than a 15% that is less secured. So our goal, again, is to really grow this thing over the long term so that even if there were some type of catastrophic meltdown, we would still be able to pay investors because our investments are scattered in markets all over the country amongst many different borrowers.
Yeah, I think that's perfect. And as it relates to compensation, Eric said it perfectly, that we don't, we're not making money on fees. I think that's where I was, I guess, disillusioned maybe with other syndications and other funds. You know, you have your assets under management and you take a big percentage fee compensation for the fund manager. It's really not how we operate. We wanted to, the way we structured the fund is basically in response to the problems that we saw with other real estate options. And one of the things that I mentioned at the outset was, or two things I mentioned, transparency. The other one was alignment. And so alignment has to do with, like, we have to be aligned. Like, we both should want the fund to grow. We both should want the fund to make a lot of money. That's the only way we get paid. You're going to get the first 10%. And the only way we get paid is when there's a delta between what we pay you and what the fund makes. So it's our job to make, to generate as much top line income through the revenue through the fund.
Well, Quinn, that's part. I'm sorry. Yeah, that's part of Quinn's question is when the snowball happens, do the returns go up? And I think Quinn, I think you're answering that question for Richard as we speak.
Yeah, the returns, the only way we don't offer upside for investors. Because there's really no upside in the fund. I mean, we don't anticipate, for example, we're getting like high teens of the fund. Will it sometimes get into the low 20s? Sure. But it might also dip down into the 15s. We don't want the performance of the fund up or down to affect that 10%. We want to keep it simple. And what we don't want is like what other syndicators do. They're like, hey, we're going to promise you a 20% IRR. Great. But that has two factors involved. That has your pref involved with it, but it also has the exit of the deal are factored into that IRR if and when they refinance or sell that asset in 3 to 5 years. We don't want to structure it that way. Number one, we don't have big exit opportunities. Number two, that's just too many assumptions to put on the backs of our investors. We want to keep it simple. And so the way to increase that 10%, if that's what you're looking for, is the compounding option that I mentioned to allow your distributions to be reinvested into the fund.
Yeah, Quinn, I would add that in my experience, 10% is really good for a debt fund. Like if you want to invest in, government mortgage bonds, it's going to be much less than 10%. The other issue is that we do have expenses that we do have to pay on a monthly basis. That's part of the equation as well.
All right. Tom asks, can you, meaning Quinn and Eric, can you supply a current inventory list?
Yes, we'll have to redact some information, but yes. Okay,
so Tom, you would want to reach out to Quinn and Eric regarding that. Somebody that does not want to disclose their name asks, how do you assure regulatory compliance with all the different states and federal authorities? Great question.
Yeah, so, I'm not an attorney and I don't want to give legal advice here, but I would just say that half of our business is completely commercial based. We only lend to LLCs. The other half, we're confident with the legal opinions that we've received and our procedures that we follow in buying these loans. We're confident in what we're doing.
Awesome. Next person who also does not want to disclose their name asks, Were the financial statements of the fund big enough to be audited, and or if not required, was this audited by an independent auditor?
No, we're not having our financials audited at this time.
Not at
As we
this.
get bigger, we'll explore that.
Yeah, I think it's size, but also timing. You know what I mean? We're coming up on year one,
Got it.
of fund existence.
Got it. But you don't have a problem disclosing that to any investor? Like me.
Disclosing the financials.
Yeah.
Yeah,
Somebody
I
just
mean,
asked. Okay.
yeah, we have nothing to hide.
Okay.
There's some privacy issues that we'll have to, address. We can't give out sensitive information regarding borrowers,
Got
but
it.
yeah, we're happy to provide that information.
And listen, I know many of you are banging away more questions in the chat and the Q&A. One person actually did ask me, Quinn and Eric, is this only for accredited investors? And I already know the answer because me and you spoke about it before we jumped on. This is for accredited investors only. Correct me if I'm wrong.
Yes, it's a 506C.
506C. So again, I don't want to discourage any of you that are non-accredited investors. The whole point of these webinars is to learn different strategies, learn different investment opportunities to eventually get you to that status of being an accredited investor, which by the way, is I think a big crock of BS in my eyes. Because
I'm with you. I love that response too, because I mean, shoot, there for a while, I was not an accredited investor, and it's like, man, I don't have all these opportunities. But I don't think that should discourage people from learning and educating themselves on what's out there. So if, when the time comes, man, you're ready.
Eric, Quinn, it's been such a pleasure. Eric, finally, I get you to do a webinar with me. So thank you for doing that for our clients. And I'm going to leave you two with final thoughts.
Just a pleasure to be able to present this to your folks, Ramez. It's again, it's something that's made a huge impact on me. And I'd love to answer any and all questions you guys have. We're an open book. It's a simple model. Looking forward to working with you.
Eric, any final words before we cut you loose?
Quinn said it best. I just really appreciate you having us today.
Thank you, guys. Always a pleasure. And hopefully we'll have you in the near future again. And thank you for your time. And look forward to our IRA Club members educating themselves, diversifying, doing their due diligence. Guys, it's always a pleasure, and we'll see you at the next one.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.